So explain and quantify how the factory should be treated. Don't worry about discontinued operations. So go through it. We're doing the 31st of March 13. So 31st of March, off we go. Before the year end, there's a board meeting. They decide to close down. Okay, so board meeting decision. You should know by now it's not enough for a provision. Not enough of an obligation yet. You need to tell affected parties. A formal plan was formulated and the factory's employees were given notice of redundancy, which will happen before the year or happened before the year, and customers and suppliers are also informed. So, affected parties informed. Okay, now we have enough for a provision. So the question is, what are we going to provide for, I guess? Okay, and they've given us the information. 50 of our 250 employees will be retrained at a cost of 125,000. Training costs. Expensed as they occur. Nothing else can't be provided for. The remainder, which is 200, i.e. the original 250 less the 50, 200 of them, they will accept redundancy at 5,000 each. That's 1 million. So I can provide for, so my provision will be for the 1 million when it happens for the redundancy costs. Okay, I can bring that in now because there's an obligation for it now. Factory plan has a carrying amount of 2.2, but will only sell for 500 less 50 costs, so will only sell for 450. So 2,200,000 minus 450, that's an impairment of 1750. So we've got 1.75 million impairment. You could show this impairment separately in its own provision, but I'll include it here. The company rents, and also the factory itself is expected to sell for a profit of 2 million. Okay, you don't show the profit, so no profit on factory shown until sold. Come back to that in a second. The company rents a number of machines under operating leases, which have an average of 3 years. They've got these operating leases they can't get out of. And it says the present value of these payments, what we'd have to pay is 1 million. However, the lessor has said, look, give them us back and just pay us 850,000, okay, which would be due for payment post-year end, but we can provide it because we've told them about it pre-year end. So 850,000, 0.85 million then for the lease costs. We're providing for the less amount. You know, we would have had to pay 1 million, but they've accepted 850, so let's provide for that 850 then. And then finally, penalty payments, because we're not going to fulfill some of our suppliers' contracts. Again, we've told everybody, so we can provide a provision of 200,000 of 0.2 million penalties. Okay, add all that up then, that comes to 3.8 million. That's the provision. Debit expense in the income statement, credit provision on your balance sheet. Now, the other thing is that we are closing this thing down. Okay, we're closing it down. And so the plant and the factory itself are now held for sale. They're not going to be used, so they're now held for sale. And if anything is held for sale, it's valued at the lower of the carrying amount and the fair value minus cost to sell. So for the factory, the carrying amount is somewhere. The factory is expected to sell for a profit of 1.2 million. So if it's going to sell for a profit, this must be higher than this. So the factory will be shown at the carrying amount. Whereas the plant, he actually gives us figures, if you remember, it was 2.2 million and 0.5 million minus 0.05 million, fair value less cost to sell. So it will be valued at that figure, because it's always the lower of when you come to do held for sale. Okay, that's how you answer that.